Good afternoon, ladies and gentlemen. Welcome back to the 4th of March weekly market review. Together with me today on this weekly market review is Mr. Gerald Wong. How are you, Gerald?
Very well. I think we have gone through the result season. There's a lot of excitement and buzz in Singapore over the last weekend. So I think that is starting to be a bit infectious as well.
Yes, talking about the bus, I think the whole Singapore was at the National Stadium at the Taylor Swift concert. But both of us are still on our desk looking at the data, preparing for this weekly market review. And in fact, I had a two-evening workshop last week on the advanced technical analysis workshop with some of our members. So if you are tuning in, I just want to say hi to you, and we'll go through some of the technical analysis later on. So, but before that, I think Gerald will give us some key updates on the Singapore market, right, Gerald?
Yes, that's right. So as usual, we will have the disclaimer that today's sharing is for information purposes only and should not be taken to be financial advice. Okay, if you find the session helpful, do leave us a review on Google by scanning this QR code or going to this URL. If you want to join us in our monthly SIAS session, take part in different investor education programs that SIAS organizes, you can consider joining SIAS as a member for $12 per year or $1 per month. And once again, the way to do that is by scanning this QR code or going to this URL. Okay, so apart from the buzz that is in Singapore, I think what is also getting a lot of investors excited is that the S&P 500 continues to break new highs. We have been talking about this for a number of weeks, and every week, effectively, we are repeating that the S&P 500 is at another record high. So it breached the 5,100 level at now 5,137. And as we can see from this chart, the Nasdaq or tech stocks are the ones that are bringing the index higher. So we see that like a lot of the artificial intelligence related stocks, a lot of the mega cap tech stocks are driving the rally. Okay. In Singapore, while there's a lot of excitement about Taylor Swift, what we don't see is the infectious rally in the US translating into gains for the STI. The STI is now back to about 3,136 points, while we see that the US market continues to reach new highs. Okay, so we have entered the month of March, in case you're not aware. So 2 months in 2024 have gone by. So I decided to do a refresh of the CME FedWatch tool. And what we see here is that the expectations of rate cuts have moderated. There is a Fed meeting that's coming up later this month, but it seems like investors are almost expecting that the rates will be kept in this meeting, as well as the next one that is coming up in May. Okay. And in terms of the first rate cut, it seems like the most likely it will only come through in June. And what this means is that for the whole of 2024, we might be looking at 4 rate cuts. Okay. If I were to look at this chart, say late last year or early this year, remember we were looking at expectations that there might be 7 rate cuts. Okay, so the expectations on rate cuts have been pushed out, and at the same time, the number of rate cuts have also been reduced. Okay, we mentioned earlier that the Singapore market has not done as well compared to the US market. So this is a recap of the STI top performers and worst performers for the past week. We saw Yangtze Shipbuilding leading the gains of close to 8% after the company announced its full year results, where the margins were stronger than expected, and the company also increased the dividend payout. Okay. Next, we also have SETS, Seatrium, and Venture gaining about 2% each. And we don't have other STI stocks that had significant gains in the past week. Okay, in terms of the worst performance, we have a number of the property developers, so UL and City Developments. down 5 to 10%. Then we have a number of REITs, Frasers Logistics and Commercial Trust, Maple Pan Asia Commercial Trust, giving back some of the gains that we saw towards the later part of last year. Okay, so we are still having the results reporting by a number of companies in the past week. I think there were a few that caught the attention of investors. And naturally, one of them would be OCBC. After what we saw in terms of DBS and UOB reporting their results, OCBC was the last Singapore bank to report the results. And after, okay, so it's quite interesting in terms of the share price performance. Before the results, you actually see the share price of OCBC going up to a 52-week high, close to $13.50. And then after the announcement of the results, going back to the $13 level. Okay, so what is it about the results that disappointed investors? Okay, so first and foremost, if you look at the group performance of OCBC, the fourth quarter net profit was at 1.6 billion. So this was actually below what the market was expecting, which was at 1.7 billion. Okay. So compared to a lot of the US stocks where we see that the companies reported stronger than expected results, we don't see that in Singapore. And that is one of the reasons the STI has not done as well compared to the S&P 500 index. Okay, so what is actually driving the disappointment in the results? I think we can start by looking at the non-interest income of OCBC. And what you see here is that the non-interest income fell to about 811 million in the fourth quarter, compared to 973 million in the third quarter and 1.1 billion in the second quarter. Okay, so this is one of the reasons why OCBC's results were weaker than what the market expected, because the non-interest income was actually weaker than what investors were expecting. We also look at the net interest margin for OCBC. What we see here is that it is at 2.29% in the fourth quarter, slightly better than what we saw in the third quarter of the year, but still below what it was able to achieve in the fourth quarter of last year. So I think this reinforced investor view that the net interest margin for OCBC may have peaked. And I guess going to 2024, there might be more concerns about how much the net interest margin could decline by compared to the 2023 levels. Okay, the next we see OCBC's dividend payout. So final dividend of 42 cents per share. And if we add the 40 cents interim dividend, that will bring the full year dividend per share to 82 cents. And implying a dividend payout ratio of 53%. Okay, so in terms of what we see in terms of the dividend payout, they've been able to meet their guidance, which is a dividend payout ratio of 50%. And what we see is that there's also a slight increase in the final dividend compared to the previous year. But once again, compared to what investors might be expecting in terms of the dividend payout, it might be slightly lower than expectations. Okay, so OCBC also gave their guidance for the year ahead. So what is important to note is that they expect the interest rates to start trending downwards, likely from the second half of this year. So this is quite similar to what we see for the expectations on rate cuts earlier, where maybe towards the second half of this year, the rate cuts will start coming through. Okay, so with this macro backdrop, what they're targeting would be ROE of between 13 to 14%. So quite close to the ROEs that they achieved in 2023. But I think if you were to look at the NIM, they are expecting that the net interest margin would be in the range of 2.2 to 2.25%. And if you recall what the level was in the fourth quarter of 2023, which was 2.29%, then what this means is that we might see a decline in the net interest margin for OCBC in 2024. Okay, in terms of dividends, they are maintaining the 50% dividend payout ratio target. So if the profit is maintained at the current level, then what this means is that there is a potential for them to be able to keep the dividend payout as well. Okay, so having seen the results reporting by the three local banks, we are able to then see what the expectations of the dividend yield is. So for OCBC, current expectation is that the forward dividend yield is at 6.5%, higher than what we see for UOB, but lower than what we see for DBS, because if you recall for DBS, they had hiked the fourth quarter dividend per share. At the same time, they have announced the bonus share issue. So with that, if they are able to keep the same absolute dividend per share, that means that the dividend yield might be higher for DBS, and that is something that investors can keep a lookout for. Okay, next we also have Frasers Centrepoint Trust. The news that came out last week was that it will be included in the STI as part of the March STI review and replacing Emperador. So we got some questions about whether we are able to provide an update on FCT. What is the prospect of FCT like? So I thought it might be useful to do a quick recap. Okay, so in case you're not familiar with FCT, don't worry, because I'm sure even if you're not familiar with FCT, you'll be very familiar with some of their assets. Okay, so 9 retail malls. Some of these are very familiar names like Causeway Point, Tampines One. So effectively, they are seen as the king of heartland malls because they own this portfolio of malls that are located near key transport hubs in the heartlands of Singapore. Okay, so what is interesting to note is that the occupancy of the retail malls are very high. Each of the retail malls has a committed occupancy of at least 99%. So if you look at, say, next, if you stay around Serangoon, you might be very familiar. It is always very crowded whenever I go there. And likewise, if you look at some of their other malls, the occupancy would also be very high at close to 100%. Okay, so that is the positive for FCT, driven by the very resilient demand that we see at some of these heartland malls. Okay, the other thing worth noting about FCT is that the gearing is actually fairly comfortable. They have an aggregate leverage of 37.2% as of 31st December 2023. And this is actually down from the 39% level as of September. Okay. The other thing to take note of for FCT is that if you were to look at the average debt maturity, it is at about 2.8 years. So the debt actually is fairly spread out in terms of the maturity. So there is no great pressure in terms of the refinancing of FCT's debt. Okay, the other thing to be aware about FCT is that they are very active in terms of optimizing their portfolio. Recently, they announced the acquisition of an additional 25.5% interest in Next. So this was completed on 6th of February. And I think a lot of investors are looking at how this acquisition of Next could be accretive towards the distributions. Outside of that, they have also been doing divestments, such as Changi City Point that was completed in October last year. Their interest in a REIT that effectively provided 39 million of proceeds. So all of this actually helps to drive up the distributions and also keep their gearing at a relatively comfortable level. Okay, so if you look at FCT's distributions, they have been fairly stable over the past few years. This is a result of the strong occupancy that we see, and generally for retail malls, it is a bit more resilient compared to what we might see for, say, the downtown malls or office buildings, because I think even in a downturn, the consumers will still go to some of these heartland malls to be buying their groceries, to be at the F&B outlets, and supporting the demand for these stores. Okay, so if you look at the price to book for FCT at this point in time, at about 0.9 times, which is in line with the historical average. And if you look at the dividend yield of FCT now at about 5.6%, which is also in line with the historical average. Okay, last but not least, I just want to touch briefly on Centrepoint. This was a stock that some investors asked about at our SIAS session last week. I think what we see is a lot of volatility in the share price. Okay, so I think that is why a lot of investors are asking about this name. Okay, so Centrepoint reported their results last week. What we see is that there was a very strong pickup in revenue. Okay, the underlying EBITDA also improved. But what we see is that the reported net loss was fairly significant at about 1.7 billion in the second half of last year, which would bring the full year reported net loss to about 1.94 billion. Okay, so most of this actually comes through from exceptional items. And if you were to look at the underlying EBITDA and the underlying revenue for Centrepoint in FY 2023, then we see a fairly strong pickup compared to 2022. Okay, so what is driving this exceptional item and the losses of close to 2 billion? Okay, so if you recall, Centrepoint really came through from the combination of previously Sembcorp Marine as well as Keppel Offshore and Marine business. So after the combination, there was a strategic review that was done. So as a result of this, they decided to write down some of the inventory because this will allow them to actually come out as a stronger group through the restructuring exercise. Okay, so that explains some of the write-downs that we saw for 2023. With the completion of the strategic review, what the company has also now proposed is a 20-to-1 share consolidation exercise. And I think what the management believes is that this will help to drive the market interest as well as attractiveness in the stock. Okay, so following the business combination, they now have a combined pool of yards, and they are looking to leverage that to be able to drive up their order wins as well as operating efficiency going into 2024. Okay, so this is being reflected in the order book. Okay, if you look at the order book as of December 2023, now at about 16.2 billion. Okay, sharp increase compared to where we saw at the end of 2022, and part of it coming through from the merger with Keppel Offshore and Marine as well. And if you look at the breakdown of the order book, about 40% of that comes through now from renewables and clean or green energy solutions, versus 60% that is non-renewables. If you look at the number in FY 2022, then a smaller proportion of about 35% will come through from renewables and clean energy solutions. Okay, the other positive about Centrepoint is that while we saw significant losses in 2023, thankfully the gearing level is still at a comfortable level at about 0.12 times. This really came true because of the previous capital raising that it has undertaken. So while there were losses reported, there are no significant concerns on the balance sheet as yet. Okay, so having gone through some of the key results that reported in the last week, we have a quieter week that is coming up ahead since the result season is almost over. We still have a few US listed tech companies that have yet to report. We've got C reporting their results today, New reporting tomorrow. And then in terms of the macro data, we'll just be looking for the US non-farm payroll data that is coming out on Friday. So with that, I'll hand over to Sunny, who will share what this actually means for the US stock markets.
Okay, Thanks, Gerald, for that sharing and the recap on the FCT. I have taken down some notes, including who gives the highest dividend now among the 3 banks in Singapore. And if I want to ask Gerald for coffee, which mall should I go to over the weekend? It's a Fraser Mall, by the way. Okay, so as the whole Singapore is at the Taylor Swift concert, you can see that the STI actually is on a second consecutive week of a losing streak. I remember last Monday when we do the weekly market review, I was saying that the STI index was pretty neutral. It was resting somewhere close to the 200 days moving average, which is the line in red that you see here. So that is a long-term kind of moving average line, which could act as a very strong support resistance level. And this week, or I would say last week, we had a convincing break below that level. And then now we are back to the very close to the support zone that we are seeing at the beginning of this year. So where is the STI likely going to go in the next few weeks? If you look at the indicators, MACD has turned quite negative. You can see that the MACD line is likely going to breach the zero baseline and also starting to diverge away from the signal line downwards. That means that the downward momentum is likely going to accelerate further going down. So the MACD is telling us that the STI index is likely going to come down further. The RSI indicator has also breached the 50-point neutral mark and also starting to diverge away from the 14 days moving average in the RSI reading as well. So another indication that there's a lot of weakness coming in the STI index. So if both indicators are agreeing that we are likely going to see a further downtrend, then likely the next support level would be the same level that we watched the previous time, which will be around this level. Okay, I'll highlight this in gray and we will follow this. We'll follow up with this in the next weekly market review. So this low over here at 3,100 points, which I said earlier, or is the exact point is 3,094 points. This is the support that we are looking at. If you look at the lower bound of that Bollinger Band, it's also around that level at 3,091 points. So this is the I will just round it off to 3,100 points. That is the key support level that you should watch out for the STI index if you would like to reparticipate back into the rebound back of the STI index. Next, let's move to the Dow Jones index or the US indices. So I think Gerald did mention some critical points about the US markets or the US interest rate situation. So at the beginning of the year, we saw some of the top tier US banks, JP Morgan, Morgan Stanley, Goldman Sachs. They are saying that we are expecting 6, 7, or 8 rate cuts this year. And looking at the latest update that Gerald provided just now, we are probably looking at only 4. So within the first 2 months of 2023, we have already seen 4 rate cuts expectation disappear or evaporated. With that being said, you can see that the index did not have any pullback. So that is one of the concerns that I have with the reduction in the expectation of the number of rate cuts. Why aren't we seeing a pullback in the index? Okay, and there's a saying in the market that the market can stay irrational longer than you can stay solvent. So I think we should all tread more carefully as we observe the uptrend of the US indices right now. Okay, so the Dow Jones index is up 0.23% last Friday, but I think on the week as a whole, the Dow was actually down as what Gerald said earlier. So Dow is actually the lagger last week for among the 3 major US indices. Of course, the tech stocks, tech heavy Nasdaq was the leader, up 1.14%, as you can see over here. So the Dow Jones index, I would say you can see from the indicators, MACD has been intertwined for quite a long time already, since the beginning of February, I would say, and that is not giving any kind of direction. But then with it being above the zero baseline and with a slightly negative reading that we see right here, I think that it may not say that the index is having any negative momentum, but definitely it is saying that it is quite toppish right now for the Dow Jones index. And the RSI indicator is now reading at 63. We are bordering just below the 70-point overbought mark on the RSI indicator. So any break above may signal a pullback or a overbought situation where we would see investors start to take some profit or lock in their position in the coming few weeks or coming few months when the RSI tests the 70-point level. Just for a reference, the highest RSI level that we reached for the Dow Jones Index, that was on the 19th of December at the level of 86. So some of the traders might have the opinion that the overbought level or the reversal level is at the 86 of the RSI level, which is referencing the December level. So that could also be one of the possibilities, but definitely we are edging higher, and as we edge higher, the overbought condition starts to get more prominent. Okay, so let's move to the S&P 500. New all-time high, as Gerald said earlier. Last week, we have a new all-time high again on the S&P 500. Indicators-wise, still very look similar to the Dow Jones Index on the top side. But we are seeing some positive momentum right now in the S&P 500. So that could carry on a little bit more. But I would say for this week, the non-farm payroll data would be the determining factor that where the market will move. So after the PPI data last Friday, which give market a bit of a breather, that was also the main reason why most of the US indices went up last week, especially the growth and tech stocks, because the PPI data came in not as hot as expected, and that's why there could be signs or assurance that inflation is really not that of a problem, and eventually it will come down in second half of the year. So, and that would be in line with what OCBC have said earlier also as well. We expect interest rate to come down second half of 2024. So that is the indication that if that happens, interest rate cuts happens again, a rally might happen. So like I said, the S&P 500, if you want to get back on this very strong rally, the 20 days moving average or the Bollinger Band basis will likely be the key level that you need to watch out for. But at least for the whole of last week, we have not seen it touch the 20 days moving average yet at the 5,023 points level. Okay, the top side of the Bollinger Band is 5,133 points. So we are above the 5,100 level now for the S&P 500, and indicators are showing signs of overbought, but it's not overheated yet right now. As for S&P 500, there is no sign of a reversal, although index might be in a overbought situation. Okay, Nasdaq was the best performer last week. Okay, I believe because you can see that the big jump really came on Friday, and that was when the PPI Producer Price Index data was announced, and that gave markets the assurance that inflation would not be sort of a going up again, at least because PPI data was not as hot as expected. So the MACD indicator, similar kind of condition, showing very topish kind of signal, but then not really saying that we are going for a reversal. In the MACD indicator, you will want to look out for the MACD line diverging, whether upwards or downwards away from the signal line, to tell us which direction the index is likely to go. On the RSI indicator, the reading at 66 is also just below the 70-point level. So I would say there is still a little bit more upside of 4 points on the RSI before we hit the 70-point overbought level, and that is the level that we need to watch out for. But as of now, the three indices is still has not touched the 70-point level, so we may have a little bit more upside to come on the three major US indices. But I think I would be watching closely what the non-farm payroll is saying this Friday before deciding if I want to participate in the current rally that we see in the US market right now. So that is the quick update that I have for this week. Gerald, will you be buying the Taylor Swift concert tickets for the next few shows?
Well, actually, someone did offer me, but it was $1,200 per ticket. So I considered for 5 minutes, and after 5 minutes, the ticket was taken up by someone else already. So I don't have the opportunity to go to Taylor Swift's concert. But I think we'll just continue to see like the excitement since I actually stay near the stadium, and actually see how that will help to boost Singapore's economy as well as the tourism sector.
Yes, that's a good point over there. We have heard in the reports that how many millions these concerts are likely to bring into the Singapore economy. But I'm still waiting for some kind of report to indicate that how much of it does it contribute to our GDP, how many percentage of it. That's something that I'm looking out for. So I think that's all the time that we have for this weekly market review. Just want to remind everyone to trade safe and stay safe because of the big non-farm payroll data coming this Friday. And we will catch you again next week on Monday in the next weekly market review. Thank you.
Thank you.